What is a real estate investment? I just finished a walk-in appointment today with someone interested in purchasing an investment property, and he asked me a question whether investing in real estate in Alberta or outside the province would be the right choice for him, particularly as an absentee landlord. From our conversation, it seems that he was just looking for some sort of validations towards his approach. So with my pink suit on, I gave him my honest opinion. What struck me the most was that many people don't fully understand what real estate investment truly means. For some, it's just simply an act of buying a property. So, what is an investment? Simply put, an investment is the allocations of time, money, resources with the expectations of generating a profit. The real question is, what is the right investment? Or the better question is, should you invest outside your area? Many people are drawn into buying a property outside their area that they don't know, or outside the province, out of town, outside Toronto where I'm at, because prices are significantly lower or cheaper. But is that the right move for you? To answer this, you need to first understand your personal investing style. Some investors are comfortable in purchasing a property without ever seeing it. They don't mind if it's made up of a cardboard boxes, for as long as it generates a profit. Others form a personal attachment to their investments, preferring to see the property in person, keeping it well maintained, and perhaps even own it in a pristine conditions for a long period of time. So is there a right or wrong way to invest? My answer is, it depends. Investing remotely can work well for some, but it does not mean that it is the right fit for you if it does not align within your investing style. What works for others may not necessarily work for you. I don't care what other real estate guru will tell you that one style is superior than the others, whether it's a pre-constructions, multifamily home, single-family home, student rentals, short-term rentals, arbitrage, local, international. They have its own place. Everyone has a different criteria. Everyone has a different tolerance, different policies, just like what works for one company might not necessarily works for the others. So here are my 4 tips in investing in real estate. Tip number 1, know the formula. You don't need the complex spreadsheets or fancy graphs or pro forma to understand your numbers. At the basic level, you just need this. Gross profit minus expenses equals your net operating income. From this alone, you can see whether you're in the positive or negative cash flow. Then decide if that number is within your investing style. Some investors focus on income approach, others on the cost approach, and some are on the time approach. Some do it alone, some do it with the joint venture partners. There is no single right and wrong method. What matters the most is that it aligns within your end goal. Tip number 2, have an exit strategy. An investment without an exit plan is like driving a car with no maps. Not knowing when to sell, when to refinance or recycle your equity can cost you both time and money. A clear exit strategy ensures your capital keeps working and your investment continues to grow. Tip number 3, keep boots on the ground. Effective property management is the key to long-term success. Decide early on if you will manage the property yourself or hire a third-party manager. Just know that a property manager is not easy to find. It may take time through a trial and error. They can be expensive and they can be super expensive if you get a bad ones. There are good ones and bad ones, so make sure that you factor this in your criteria. If you outsource, make sure that the cost is built into your numbers, as it can significantly impact your profit margin. Avoid doing minor unnecessary repairs yourself if it's taking away time from scaling your business. Tip number 4, factor in vacancy rate. This is one of the most overlooked parts of the equations. You need to know how many months you can afford to go without a tenant before your investment becomes negative. Always factor in a realistic vacancy allowances into your formula to protect your bottom line. So there you have it, and happy investing in 2025.